We are looking at a real estate example to understand call options. So the example is we are going to assume the role of a buyer of a house. We are the buyer and there is a seller. We like a certain house and the seller wants $1 million for that house. But as a buyer, we need a little bit of time, so we need to do due diligence on the price, perhaps the future value prospects, as well as arrange some financing maybe. So the buyer, that is us, we want to hold for 60 days. Buyer and seller agree on this hold, and they also agree that a premium of $25,000 is a reasonable amount to pay to the seller to get this hold. So within 60 days, we have the right to buy this house at a price of $1 million. And if we don't buy, the seller keeps the $25,000. In fact, whether we buy or not, the seller keeps the $25,000. This is a call option. It's a right to buy the asset, which is the house, at a price of $1 million, which is the strike price, and the expiry date for this option is 60 days away. So this is a simple example of a call option. As we go into this course, I want you to remember this example because we're going to continue to draw on this example for a call option. So I hope it's pretty clear. But what we're going to do is we're going to look at the details of this call option. So the buyer, which is us, we have the right to buy this house at a strike price of $1 million. And we paid a premium of $25,000 for acquiring this right. The seller has an obligation to sell it at the strike price of $1 million. Now, regardless of what the price of this house is, within 60 days, the seller has the obligation to sell it at that price of $1 million. The expiry date of this option is 60 days away. And we lose this premium of $25,000 whether we buy it or not. The current fair value of this house is $1 million. And our strike price is also $1 million. So in this case, the fair value of the asset and the strike price of our option is the same. It's $1 million. This option is called an at-the-money option. It's at the money because the current price of the house and the strike price is the same. So this is an at-the-money option. So now what we're going to do is we'll assume that within 60 days, this house appreciates to $1.1 million. And we just want to see what happens to both the buyer and the seller if this happens. So the house value appreciates to $1.1 million in 60 days. As a buyer, we have the right to buy this house at $1 million. So we can exercise our right to buy the house at $1 million. Now the seller is obligated or obliged to sell the house at $1 million and therefore he gets assigned on this contract. Our total expense or our total cost was $1 million plus the $25,000 that we paid in the premium, $1,025,000. Our profit, therefore, if we could sell this option in the marketplace, our profit, therefore, is $75,000. But we used only $25,000 capital to do this transaction. So our return on the investment was $75,000 divided by $25,000, which is a 300% return. A big takeaway, options are a leveraged instrument. So you will see that your returns, whenever you deal in options, can be magnified. And it can be magnified both on the upside as well as the downside. But let's just take a simplistic case here that we had the upside and therefore we could see a return of 300%. So there are actually three different takeaways from this example. So let's look at each one of them in detail. As a buyer, the maximum we could have lost on this deal is $25,000. Why is that? Because if the price of the house went down below $1 million, then we're not going to exercise our right to buy the house. Remember, we have the right. We don't have the obligation. The seller has the obligation. So as a buyer, we have the right to exercise or not to exercise. And so, as a buyer of an option, your loss is limited to the premium that you paid. But your profit is unlimited. So imagine if the price of the house went up to 1.2 million or 1.3 million, we get to participate in all of that upside. So that's a big takeaway. As a buyer of options, your losses are limited and your profits are unlimited. The second example is leverage, and we saw that on the previous slide. So leverage is an important component of options. And another quick example is your home loan. So let's say you bought a home for $1 million and you paid $200,000 as your down payment. And 3 years later, that house was worth $1.4 million. Now, although the house increased by 40%, your return is actually 100% because you put $200,000 down payment and you got a profit of $400,000. So that's an example of leverage at work even in the real world. And an option is just the same. So you have leverage built into it. Now leverage works both on the upside as well as the downside. So we'll need to be careful about that. And in this course and future courses, we'll be pointing out this aspect of leverage all the time. As a buyer, we paid $25,000. So our cost basis was $1,025,000. So the third takeaway is that the price of this underlying asset, which is the house, must move higher by the premium paid. So the takeaway is, whenever you buy a call option, the break even for that call option is the strike price plus the premium. The strike price was at 1 million and the premium we paid was 25,000. So for that call option to break even, it must cross that threshold, which is the strike price plus the premium. Let's now quickly look at both the buyer and the seller's risk and reward profiles. If you look at it first from the seller's standpoint, the maximum the seller could have gained in this deal is $25,000. And why is that? If the price went to $1.1 million, he lost out on $75,000 in potential gain because he was assigned this contract and he had to sell the house to the buyer at $1 million. But he got $25,000 in premium. So his break even was also $1,025,000, and anything above $1,025,000 was a loss for him. And if the price fell to $900,000, he gets to keep the premium of $25,000 because the buyer is obviously not going to exercise that option. And therefore, his maximum gain in this deal is $25,000. The seller gains as long as the price is below $1,025,000 on the date of expiry of this option, which is 60 days away. And we just saw that the call option break even is the strike price plus the premium for both the buyer as well as the seller. And beyond $1,025,000, the seller starts accumulating losses. So from a seller's standpoint, his profit is limited, but the losses are unlimited. So you might be thinking at this point, why would anyone be a seller of options? And I want you to hold that thought, because while this is a valid question at this point, we'll see why it's the case that the profit and loss profile or the risk and reward profile is not really skewed towards the buyer. And we're going to see that as we go along. In fact, I'll give you a spoiler alert here. you're going to see that as you become proficient in options, you're going to assume the role of a seller more than the role of a buyer. So you're likely, I won't say you are for sure, but you're probably going to like selling options or selling positions much more so than buying positions. So, this is the very interesting aspect of a buyer's profile and a seller's profile. But unfortunately, you're going to have to wait for that because we're nowhere near understanding that concept yet. In the next lecture, I want to cover two scenarios for buying this option. So bear in mind, in this scenario, we bought an at the money option. So the current price of the house and the price of the option was at $1 million. So this is an at the money option. In the next lecture, I want to cover in the money and out of the money options.